Welcome to the Infrastructure Think Tank's Explainer series, where we break down the structures, contracts, and financing mechanisms that make public-private partnerships, or PPPs, work. In this episode, we explore a critical question: how are PPP projects actually financed? When a government signs a PPP contract, especially one structured as a design, build, finance, operate, and maintain (DBFOM) project, the private partner takes on the responsibility to raise all the funds needed for construction and operation. But how does that happen in practice? Let's take a closer look at the financial structure of PPPs, the categories, instruments, and sources of funds that make these projects possible. At the core of any PPP project lies a mix of debt and equity, just like any corporate finance structure. Debt represents borrowed funds, typically loans or bonds, which must be repaid with interest. Equity represents ownership capital, usually provided by the project sponsors, contractors, or financial investors who take on the highest risk, but also stand to earn the highest returns. In most PPPs, this mix is carefully calibrated to achieve an efficient gearing ratio, typically between 70% debt and 30% equity, to keep the cost of capital low while ensuring the private partner has enough stake in the project to deliver results. Equity is the foundation of the project's risk capital. It's what sponsors and investors put into the project before lenders step in. There are three main categories of equity providers: contractors or industrial developers. These are companies with a direct interest in the construction or long-term operation of the asset, such as engineering or facilities management firms. They invest equity to align their performance with the project's success. Financial investors. These are institutions, such as infrastructure funds, private equity firms, sovereign wealth funds, and pension funds, that invest purely for returns without directly building or operating the project. Many of these investors prefer brownfield PPPs, projects that are already operational, because they avoid construction risk while still earning steady, predictable income. Their involvement also helps developers recycle capital into new projects. Government co-investment. In some cases, the government itself takes an equity stake in the Special Purpose Vehicle, SPV, through a strategic investment fund or development finance agency. This helps improve investor confidence and align public and private interests. In advanced markets, even retail investors, individuals, are starting to participate through initial public offerings, IPOs, of infrastructure project shares. Between debt and pure equity lies a hybrid category called quasi-equity, instruments like junior debt or mezzanine financing. These funds sit below senior debt in repayment priority, but above equity in the risk hierarchy. They typically offer higher returns to compensate for higher risk and are often provided by the project sponsors themselves for tax efficiency, or specialized financial investors and, occasionally, governments looking to boost project bankability. Quasi-equity is often used to fill financing gaps and make a project's capital structure more flexible. Most PPP financing comes from debt. Debt reduces the project's overall cost of capital because interest rates are lower than expected returns on equity. Debt may come in several forms. 1. Long-term loans. These are the backbone of most PPPs and are typically provided by commercial banks, investment banks, and development finance institutions. Major players include multilateral development banks, like the World Bank, IFC, or African Development Bank, export credit agencies, ECAs, and national development banks, NDBs. They either lend directly or provide guarantees and credit risk insurance, which improve the project's bankability and attract private lenders. 1. Short-term or mini-perm loans. In markets where long-term loans are hard to obtain, private sponsors may use short-term or bridge loans with plans to refinance once the project becomes operational. These are called mini-perm loans when structured under project finance principles. 1. Project bonds. In advanced and emerging markets, project bonds are becoming an increasingly popular tool for PPP financing. Bonds allow the SPV to raise funds directly from institutional investors like pension funds, insurance companies, and sovereign wealth funds. Countries like Chile, Mexico, and Peru have successfully used project bonds to deepen their infrastructure capital markets, sometimes with multilateral banks acting as anchor investors. 1. Other debt structures. Some PPPs use leasing, supplier credits, or Islamic finance to fund equipment-heavy projects. For instance, suppliers may agree to deferred payments, which are later discounted to a third party under a process known as forfeiting. A significant evolution in PPP financing has been the rise of infrastructure funds. These funds operate much like private equity funds. They pool capital from multiple investors, called limited partners, LPs, such as pension funds, insurance firms, family offices, and even banks. A professional fund manager then deploys that capital into infrastructure projects, overseeing returns and risk throughout the fund's life. Infrastructure funds often invest in the equity of PPPs or buy into operational assets, providing liquidity for developers and stimulating the pipeline of new projects. Their participation also signals strong market confidence, encouraging other institutional investors to participate. For governments, attracting these specialized funds requires designing PPP contracts that allow flexible equity transfers, ensuring investors can enter or exit the project without disrupting service delivery. To summarize, a PPP's financial structure typically combines equity capital from contractors, financial investors, and sometimes government partners, debt financing from banks, MDBs, ECAs, or capital markets, and quasi-equity instruments for flexibility and tax efficiency. All these funds flow through a special purpose vehicle, SPV, the legal entity that signs the PPP contract and manages all revenues, expenditures, and debt service. This ring-fenced structure isolates the project's finances from the parent companies, ensuring transparency and accountability while protecting lenders and investors. Privately financed PPPs are complex but powerful tools for delivering infrastructure. Their success depends on a carefully balanced financial structure, one that aligns risk, return, and accountability among contractors, investors, lenders, and governments. As emerging economies continue to expand their PPP pipelines, understanding how these financial layers interact will be crucial to ensuring sustainable, bankable, and investable infrastructure projects. At the Infrastructure Think Tank, our goal is to demystify these structures, helping policymakers, financiers, and citizens alike see how capital and creativity come together to build Africa's future. Stay tuned for our next episode, where we'll explore how governments can influence financing structures through guarantees, co-financing schemes, and risk-sharing mechanisms to make projects more attractive to private investors.